Let's take a look at the broad market, and we are joined by Alexander MacDonald, Portfolio Manager in Focus Wealth Management. Thank you very much indeed for joining us, Alexander. Really appreciate it. What are the big themes you're looking out for in 2026?
You know, just before the break, Andy, you were saying Amazon was a bit of a dog. To find some dogs, some real dogs from 2025, we can look no farther than the pet industry, actually. So more recently, we've had some well-publicized weakness, in industries associated with tariffs. And then with youth unemployment, of course, it's been another theme where we've seen some weakness in spending there. But independently, two separate companies operating in the pet industry have recently flagged some weakness within that industry. And that's a bit of a departure from what we've seen historically there. If we go back to 2019 to 2024, we've actually seen households in Canada with dogs increase ownership by about 3.3% a year. And even if we go to the premiumization or humanization of pets within the household, premium dog food sales have increased about 12% year over year over that same period of time. So what we've seen recently in this industry with a slowdown in sales is a bit of a departure from what we've seen over the medium and long term. And we think if that reverts to the mean, some of the names I'm going to talk about here could do well over the coming years.
Is Pet Valu one of the names that you're talking about here, Alexander, PET, in Toronto?
It is. Pet Valu is the first one, so I'm sure a lot of viewers are familiar with it. It's a retailer of pet supplies coast to coast in Canada. It's got about 850 stores. Leading market share in Canada as well, about 18% of the spend on pets in Canada goes to Pet Valu. More recently, though, the stock has been down. It's down about a quarter since September, and that's on weaker same-store sales than what investors were expecting. Barely above zero, barely cracking any growth at all, and that compares to the previous 5 years where it averaged about 10% same-store sales. Management has blamed this on, as I alluded to earlier, weaker consumer spending, specifically on the discretionary side of things, so those pet toys that you don't have to go out and buy for your dog, but you maybe choose to from time to time. Those sales have not been keeping up. Longer term, though, we do like the opportunity. Pet Valu has a very good customer loyalty program that's untapped, that I think they can really dive into a bit more and start to upsell customers with more and more goods. And they've also just completed a $100 million investment into building 3 new distribution centers in Canada, which we think solidifies their moat and it's going to make it harder for competitors to compete with them. And lastly, with valuation at 16 times earnings, we think it's pretty attractive for investors to get in here, which we recently did at Focus, buying within the last month or so.
Any other stocks that have lagged this year that you see value in, Alexander?
Yeah, specifically with the same industry, Zoetis is another one it's down about 25% year to date. So,
sorry, that's the animal health player.
Correct, yeah. Yep. For people who aren't familiar with it, pharmaceuticals for animals is where it specializes. It's about 2/3 companion animals, so pets and so on, and 1/3 livestock. It's suffered as well for a couple of reasons. One of them, as Pet Valu mentioned, consumer spending, discretionary spending isn't what they had expected. So as it applies to Zoetis, people aren't taking those discretionary trips to the vet. And if they don't take their pet to the vet, they're not getting prescribed pharmaceuticals. But secondarily, and this is more specific to Zoetis, what was supposed to be their next blockbuster drug, Librela, it's used for osteoarthritis pain in canines. It didn't pan out to be that next big blockbuster that they were hoping for it to be. There's some controversy on social media about whether there are some side effects that aren't welcome in these animals. Whether or not Librela does bounce back and become a next big hit, we're not specifically worried about that because we think longer term Zoetis has a great drug pipeline. They spend about 2 times as much as their next closest competitor on R&D, so we think that pipeline can continue to grow. So longer term, we think it should do well, and it's only trading about 18 times earnings for it has pretty dominant market share. It's normally the number 1 or number 2 player in each of its key segments.
I'm looking at a headline here on Bloomberg that our population in Canada slipped only by 1/5 of 1% in the third quarter, first since COVID. I wonder, is that bad news for some retailers, fewer new households being set up in the country?
It is, and that is contributing to some of the weakness we've seen amongst retailers of all shapes and sizes. I mean, not just in the pet industry, but in the U.S. too. Some of the lower income households aren't spending as much as retailers would like. But, you know, we're not going to invest, at least at Focus, one quarter at a time. Over the long term, population growth should, you know, come out somewhere between that 1% to 2%, GDP growth sort of around 2%. And for those well-performing companies like the Pet Valus and the Zoetises, we think with good operations and an attractive offering to their customers can obviously grow a lot more than that over the long term.
What about the Canadian banks? Obviously a mainstay. They have been hitting record highs this year. Are you overweight or underweight?
So we own two banks, Royal and Scotia. Royal obviously has been the top performer of the group for quite a long time. As a result, it gets a premium multiple, but most people would argue that that's deserved. We're happy owning it here. It continues to execute very, very well. We like it specifically, its operations in wealth. They're a little oversized in that business compared to some of the peers. Scotia, when we bought it, I think it was back in June or so, it was unloved. It was one of the laggards of the group. They're a couple years into a bit of a refresh of the strategy, a bit of a turnaround. And it was trading at a pretty discounted multiple compared to the peer group. We thought that discount was not warranted, which is why we decided to go in and buy the shares. And it's worked out pretty well, thankfully, since then. But we continue to hold it, continue to like it, and we do think it has quite a good runway going forward. It's really focusing on its operations in Mexico, U.S. and Canada, as opposed to some of the Latin American operations it's known for previously.
I think we better jump. Alexander, thank you very much. If we don't talk to you before year end, have a great holiday and a wonderful 2026.
Thanks, and Merry Christmas to you too, Andy.
Thank you very much indeed. Alexander MacDonald of Focus Wealth Management.